Hello everyone and welcome to Nettle, the best platform around for distance learning in business, finance, economics and much more. My name is Sava and today we're going to cover some option strategies, so derivatives trading strategies that will help you to profit from your market forecasts regarding the potential direction of the stock prices and potential volatility of the market in general. So obviously when you are trading options, there are four potential strategies you can go with if we are talking about the simplest ones. So you've got your usual calls and puts, so call and put options, where call options give you the opportunity but not the obligation to buy the underlying asset at a specified strike price at the specified exercise date or maturity date, and put options that give you the opportunity but not the obligation to sell the underlying asset at a specified strike price at a specified maturity date. Here we are considering just the European options, so the simplest of the vanilla option types. European options, unlike American options, are exercisable only on the maturity date, whereas American options are exercisable at every single trading day up to the maturity date. So generally, American options are more valuable, they have higher option premia, but European options are easier to simulate, to value, and to exercise strategies based on. So up from now, we're gonna deal with European options only. So without further ado, let's investigate some of the simplest bullish and bearish strategies based on European options. So if you believe that the stock price of a particular company, so that's your underlying asset, that's a stock of a particular company that's liquidly traded and options are being available to buy or sell, well, if you believe that the stock price of this company will go up, then you can choose one of the two option trading strategies. You can either long a call option for the stock of this company, or you can short a put option for the same company. So the logic is that if the share price of the company goes up, then you would be able to beneficially exercise the call option as you are the holder of the call, and when the stock price is higher, you'll be able to exercise your right, so you'll buy the stock at the strike price that is lower than the share price that you forecast to be in place when the option matures, and you obtain the payoff. That's the difference between the share price, whatever it is, at the end of your trading period and the strike price that you'll be able to buy the stock for. In case of the short put, well, you're writing the put option, so you're selling that. So you straight away obtain the option premium. So someone else, someone who you sold the option to, has the right to exercise the put option. But if the price goes up, they won't be able to benefit from holding the put option you have written to them. So if your forecast is correct and the share price indeed goes up, then they have no incentive to exercise their right, and you are getting away with just getting the premium and they allow the option to lapse. So that's the logic. Now let's simulate those two option trading strategies that are inherently bullish based on a well-known company traded on the London Stock Exchange, RELX PLC. Let's assume that we are currently on the 13th of January 2020 and we select an option with a maturity date of the 21st of February 2020. So it's a relatively short-term option trading strategy which covers slightly more than a month of the investment horizon. So what can be potential forecasts that underlie this option trading strategy? Well, it has been announced on the 13th of January 2020 that RELX PLC is targeting to acquire a number of smaller companies, so potentially they can extract a lot of value of those M&A activities. So we assume that the market will reflect this increase in corporate value over this relatively short period of time, and we'll be able to benefit from our forward-looking forecast that the share price of RELX PLC is going to appreciate. So at this point in time, 13th of January 2020, we can either long a call option in RELX or we can short a put option in RELX. So what we need to understand is what's going to be the share price at the start of our trading period. And we know that because, well, that's the share price in place in the market at the time. And that's 1946.5 pence per share. And bear in mind that London Stock Exchange is a very peculiar place, as that's the only stock exchange in the world where the price is quoted in pence. So that's not pounds, that's pence. So it's roughly 19.5 quid per share. And option prices are as well quoted in pence. So don't let that confuse you, as in all other major stock exchanges you'll have prices quoted in dollars, not cents, euros, not euro cents, but on the London Stock Exchange it's always pence, not pounds. So that's just a small peculiarity, characteristic of this particular stock market. So if we believe that the share price is going to appreciate, we can either longer call or shorter put. And in case of those simple option trading strategies, you need to select a strike price that's as close to the center price, so the share price at the start of the trading period, as possible. And for the sake of liquidity, it's not always the case that you'll have options at any strike price you can imagine. Because if you had option prices at every single pence as a strike price, then you would not have enough trading for the option market to be liquid, for there to be enough price discovery. So what generally occurs on the option market is that you have available strike prices at reasonably narrow ranges that are sufficient to execute all sorts of various option trading strategies, but that are wide enough to encourage enough liquid trading at every single spot. So in case of RELX, strike prices go in a step of 50 pence. So you would have options being available for like 1800 pence, 1850 pence, 1900, 1950, 2000, and so on and so forth. So as it's relatively easy to understand, that's the closest strike price to our center price of 19.5 pounds roughly is 1950 pence, which is manifested here. So we're both gonna long a call option at 1950 pence and short a put option 1950 pence. What we also need is to understand what are the current option premium that we can either long the option for or short or write the option for. So obviously you could just look at the last prices, so the prices at which the last trade in these options occurred. But that would not be totally realistic, and that would not truly reflect the transaction costs in place at the options market. What you have to look for, if you want your trading strategy simulation to be as realistic as possible, is to look at the Bidask Spread, so bid prices and ask prices. And you always need to simulate longing an option, so buying one at the ask price, and the writing of the option, so selling it or shorting it at the bid price. What is the reason for that? Why? Well, bid and ask prices reflect the current limit orders that are being in place, and someone has issued them previously at the market. So if you want to buy the option right now, you'll need to satisfy someone else's limit order for this option. So you would need to buy it at the ask price. And if you want to sell the option immediately by issuing a market order of your own, you'll satisfy someone else's limit order that is currently being in place on the market, so that will reflect the bid price. And the Bidask Spread reflects one of the dimensions of market liquidity. So the higher the Bidask Spread, the lower is the liquidity of the market, the more illiquid is the market, and the more difficult arbitrage is on that particular option market. So in our example, the premium for the long call, so the ask price of the call option for RELX PLC at the expiry date of 21st of February 2020 was currently at the 13th of January 2020 standing at 52.5 pence per share. So that's the ask price. As for the bid price for the respective put option, so that's the price that we'll get, so the premium that we'll obtain by writing a put option at the strike price of 1950 pence is 41.5 pence per share. So that reflects the Bidask Spread Obviously, naturally, the prices for put options at the center price are slightly lower than the premium for call options at the same strike price, because of the general tendency of stock prices to go upward with time. But also what those premia reflect is the volatility, because the more volatile is the underlying, the more volatile is the stock price, the more likely it is for the stock prices to move either below or above the strike price. And again, here let's learn some useful jargon in terms of option trading. Well, if the strike price moves above the share price, so the share price is below the strike price, then it's said, it's very frequently used expression that the option is in the money. And if the share price moves above the strike price, then the option is to be considered to be out of the money. When the two are exactly equal, then the option is considered to be at the money. At the first glance, that can be considered a very peculiar bit of jargon, but it's useful to understand it if you are trading options in the industry. Without further ado, let's simulate potential payoffs that we'll receive from either long in a call or short in a put at those particular strike prices with those particular premia. First of all, the gross payoff is just the payoff that we can obtain from exercising our option, or that we will lose from our counterparty to exercising the option that we have just written for them. And the net payoff takes into account the premium that we either have to pay or that we receive. So the gross payoff of the long call solely depends on whether the option is in the money or out of the money, so whether the strike price is above or below the current share price that will be in place at the end of our trading period. So let's simulate the option payoff for a plausibly wide but not too wide range of prices. So what do we expect to be plausible to happen at the end of our trading period on the 23rd of February 2020? So we'll move at the steps of 10 pence and move from 1700 all the way up to 2300 pence per share. So the gross payoff would solely depend on the underlying share price. So if the share price of RELX PLC is lower than the strike price that we've bought the call option for, then let's think, is it beneficial for us to exercise our right? Because remember, that's us who ultimately makes the decision whether to exercise our option or not. We have the opportunity to buy the underlying share at 1950 pence per share. If the current market price is lower than that, we have no reason to do that. We would have gotten a better deal by just buying the stock at the spot market. If we decided to exercise the option though, we would have bought it at 1950 and sold it for whatever it is that's less than 1950. So we would have gotten a negative gross payoff. But as it's our choice ultimately whether to exercise the option or not, we can just allow the option to lapse and get the gross payoff of 0. So pretend that the option was not there and just move on as we did. So if the share price is lower than the strike price, if the call option is in the money, it's not being exercised and the gross payoff is 0. However, as the call option moves out of the money, if the underlying share price at the end of our investment period exceeds the strike price, then it's easy to see that we can benefit from exercising our right. We could buy the underlying stock at 1950 pence per share and sell it for whatever the share price is, so for a higher value than 1950. And our gross payoff ultimately will be the difference between the two, because we can sell for whatever the share price is, provided that's higher than the strike price, and pay our counterparty, so someone that has written the call option for us, 1950. And we need to lock that because the strike price is the fixed component of the options contract. And that's all there is for the gross payoff of the long call. And we see that when the share price is 1700, so much lower than the strike price, then we're not incentivized to exercise our call option, and then we have the gross payoff of 0. But obviously we also need to account for the option premium to get from the gross payoff to the net payoff. In case of the long call, we are buying the option, so we are getting this optionality, this right, and those optionalities, this exclusive right to buy the underlying stock at 1950 pence per share, it doesn't go for free. We have to pay our counterparty to have this right, and they have to be rewarded for taking on this hassle of satisfying our right. So we need to subtract the option premium from our gross payoff, and we need to lock the option premium, because again, the option premium is another fixed component of the option contracts. Option contracts have three notable characteristics, so two fixed and one variable. The variable characteristic is obviously the underlying share price at the end of the investment period, at the maturity date. And the two fixed components are the strike price and the option premium. That's why we don't leave the share price, the underlying share price, locked, and we lock the strike price and the option premium to reflect that. So we can see that obviously our gross payoff is zero, but our net payoff is negative option premium, because we had to pay that and we didn't get any payoff from exercising the option after that. Then we can bottom right click it all the way down and see what the payoff structure of the call option of the long call looks like. So we have limited downside if the price goes down. Then as the share price exceeds the strike price, so as it starts exceeding 1950, as the option starts moving out of the money, then the call option is beneficial to exercise and our payoff starts increasing. But please note that if the share price increases a little, then we do not break even, because the premium that we have to pay is lower than the gross payoff we have obtained from exercising the call. So we start profiting from the long call only if the share price increases a lot from the strike price. So we break even around 2003 pence per share at this region. But the good thing about a long call is that our upside is potentially unlimited. As the share price moves way above the strike price, our payoff increases further and further. So that's the characteristics of a long call. We have fixed downside when the price goes down and ever increasing upside when the price goes up. One way of graphically incorporating that logic is to construct an option payoff chart, and that's the most frequently used visual tool to illustrate the structure of your option strategy's payoff. So to do that, we need to select the share price, gross payoff and net payoff, select all three columns and insert the payoff chart. The easiest and most convenient tool to visualize it in Excel is to select the scatter plot with straight lines. So you need to select the bottom row, the middle chart, and select the scatter with straight lines. And we'll see that this is the payoff structure of the long call. If we want to tidy it up a little bit, so consider just the range of prices that we're interested in, we can just right click on the axis, format it, and select our minimum price. So our minimum price was 1700, and our maximum price that we want to consider is 2300. And we see that now the situation is much clearer. We can see that our downside is limited to 52.5 pence when the price moves below the strike price, so when the option is in the money. When the option moves out of the money, our payoff is ever increasing, so our upside is unlimited. That's the main characteristic of the long call. Now let's consider another bullish strategy. Let's consider the short put. In that case, we are writing the option, so someone else has the right to exercise the option. So someone else has the right, not the obligation, to sell the underlying stock to us at 1950 pence per share. So we have no control over whether our counterparty would exercise that, but given the fact how simple are the underlying incentives in the option contract, we can with certainty forecast what our counterparty is going to do depending on what the share price is going to be. So let's try and unravel this logic. So if the share price is lower than the strike price, so the option is in the money, does our counterparty has an incentive to exercise their option? So they can sell the underlying stock to us at 1950 pence per share. So they want to do that because the current share price is lower than the strike price. They can buy the stock at, for example, 1700 and sell it to us at 1950. It means that they gain gross payoff based on the put option that we've written to them. What it means for us, though, is that we have to buy it from them at 1950, and we are left with an overvalued stock, pretty much, on our hands that's worth much less than what you have paid for it. So it's easy to understand from that that we are losing from our short put. In terms of the numerical value of our gross payoff, we need to consider the following. We need to pay the strike price, 1950, because we are obliged to buy it. That's the offer we cannot refuse. And then the best way we could have dealt with that is just to sell the stock at the market price. So we are gaining the market price, and we are paying our counterparty the strike price. And if the option moves out of the money, then, well, we're happy, because our counterparty doesn't want to sell the stock to us at 1950, because they can get a better deal from the market. They can sell it at a higher price on the market. So it means that the option is not exercised, and we are happy because our gross payoff is zero, and we just got the premium without going through any hassle of exercising the right of our counterparty. So put options are not exercised out of the money, so the gross payoff here is zero. And what about the net payoff? Well, in case of the long call or long option strategies, we are obtaining the optionality. So we have to pay for the inherent risk to our counterparty, because no one would write an option for free. In that case, we have written an option, so we have taken the risk of potentially losing like as much as minus 250. In that case, we are the writer of the option, we are selling that, so we are obtaining the option premium. So to get from the gross payoff to the net payoff, in case of short option strategies, we need to add the option premium to our gross payoff. And again, we need to lock that because the option premium is the fixed component. So again, now we can select that and bottom right click it all the way down. And from here already we can see the structure of the payoff of the short put. We have unlimited downside when the stock price goes down, and we have fixed upside when the price goes up. But what is peculiar in terms of the comparison between a long call and a short put is that you gain a fixed amount whatever the share price increase is. In case of the long call, we needed the share price to increase a lot before we start gaining on that. In case of the short put, you gain a fixed amount even if the share price stays the same. What is also interesting is that when the share price starts decreasing, the put option becomes exercised, so we start losing on gross, but given the fact that we've received a high premium, we are not losing on net all the way until the share price actually decreases significantly below the strike price. To represent it graphically, we could select the share price column and select the gross payoff and net payoff columns, and again put up the scatter with straight lines, which is the typical graph for the option payoff structure, and format the x-axis to just reflect the range of underlying share prices that we are interested in. So from £17 to £23, we see that our upside is limited at the option premium that we receive, so 41.5 pence per share, and as the stock price starts decreasing below the strike price, the put option moves in the money, it becomes exercised, and we start losing. But we do not lose on net all the way until the share price goes somewhere around 1910 pence per share. So that's the logic of the short put. The other interesting thing that you could see is to compare the payoff of the long call and the short put, and that would allow us to determine what are the inherent beliefs of someone who wants to execute this or that option trading strategy, and their beliefs about the volatility of the market. If we select the column with the share prices, the column with the net payoffs of the long call, and the column with the net payoffs of the short put, and get it all on the chart, we can see that if the share price increases a lot, the long call payoff structure is much more attractive, as our upside is again unlimited. But if the share price moves up a little, then the short put becomes the more attractive strategy. From that, and from the fact that the incentives of the counterparties are relatively clear, we can pinpoint that even though both of those strategies, long call and short put, are bullish, the long call strategy assumes higher market volatility than the short put strategy. In case of the short put, you expect the share price to increase, but to increase to a lower degree than if you would go for a long call. So that's how you can determine what are the inherent market beliefs, what are the characteristics of someone's market forecasts, if they are going for either a long call or a short put. If they're going for either of the two, you can be certain that they are bullish in terms of the direction, but for the short put, someone expects lower volatility, so they're bearish on volatility. And if someone goes for the long call, they are expecting high volatility, so they are bullish on volatility. That's all about bullish simple option trading strategies. Next time we're going to consider their bearish counterparts. Thank you very much and stay tuned for the next episode.